Welcome to Striking Option, and the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Bob Iaccino. Welcome, Bob.
Good to be here, Jeff.
Well, a special Valentine's edition here. So my question is there still going to be love in the market? We've seen quite the move off of that December 24th, but Chinese trade tariff conversation, front and center. Are you focused on that as well?
Well, you talked about that, and the key word, I think, is love. There has to be love between the U.S. and China. They have to get to some sort of a deal. Even if it's the same deal with a new name, that'll be better than where we're at now.
And I think those are the expectations that the market really is grasping and embracing on this Valentine's Day, Bob.
Yeah, and again, that's really the last sort of domino to fall. Economic weakness is starting to come into play. They got to get this done.
Great stuff. All right, you ready for this first lightning round?
I am ready.
Crude oil. Well, it's interesting. The whole Chinese tariff conversation ties into crude oil. What are your thoughts on the WTI as we've seen a little bit of a slowdown around this $55 level?
Well, as you mentioned, it hits demand expectations. But the seasonal factors are starting to come into play. So what I want to do, with volatility having fallen every single week this year, it's been lower and lower, I'm buying the April 55-58 call spread in crude oil. Now again, this is a seasonal play for me. This time of year is one of the steepest and strongest seasonal tailwinds to the market that you're going to see for any given year. That's about 20 years of data.
No, that makes a lot of sense, Bob. So what would a call spread like this cost an investor?
So again, the example I'm looking at, I'm going to buy the 55 calls for $1,600, and I'm selling the 58 calls for $600, net of about $1,000. The buying of this call spread costs the investor about $1,000. A lot of times we do it the other way. It's a $3 call spread that expires as an April month leader, but expires on March 15th.
This makes a lot of sense, and you have some time in this trade example. And remember, the April is underlying future contract, and when this was trading around 54.40, this trade example was priced out. And that at-the-money volatility you talked about has certainly decreased, and the at-the-money volatility was 31, Bob.
Yeah, and you have to keep in mind that seasonals are a tailwind, not a guarantee that things are going to go higher.
All right, I like it. And please remember, these are trade examples, not trade recommendations. Let's move into the second lightning round.
Ready for it.
Trade tariffs. Well, there's a shocker, Bob. Interesting to see how we continue to talk about these trade tariffs, but it seems like with the Chinese-U.S. conversation re-engaging today on Valentine's Day, will we see some love?
Well, again, the trade tariff is one of the last dominoes to fall, but we're starting to see weaker and weaker economic data. Just got really weak retail sales data. So again, I think politically and economically, this has to get done. I believe it will, but that's my personal opinion. And again, I don't know if the deal is going to be a good one or a bad one. I just think there's going to be one.
Well, I'm looking at the options on the E-mini S&P 500 futures. And the reason why I'm looking at this is you actually hit the nail on the head when you talked about that decrease in volatility. Since volatility has come down dramatically since December, I'm looking to buy a put spread on my trade example. By buying the E-mini 2700 Feb end of month put, that's going to allow me to cost about $780 for that. But I'm also going to sell the 2650. So this is a 50 handle put spread. And in the event we do see a little bit of a pullback here, it's going to make a lot of sense owning that risk mitigation. And typically we like to put a put spread on when you do see that market really move up higher like it has.
Yeah, again, different for striking options. We do a lot of selling and buying and selling of the spreads. Buying one here makes sense again because of that volatility answer.
And this trade expires at the end of February, 2/28. And the E-mini S&P 500 contract, the underlying, was actually trading around 27.40. But Bob, we talked about the at-the-money volatility. What was that at-the-money volatility on this trade example?
It's about 13.28 when we price this one. Again, falling below 15 has been kind of a resistance, or a support level rather, for volatility. Getting below there, good time to put on this trade.
It always talks about defining our costs. Utilizing option futures, you can define your cost in this specific trade example for about $390. But Bob, I always want to say to you, thanks for pointing out the volatility. It's such a critical component. I think viewers take away from that, knowing where the volatility regime is actually placed.
It's one of the first things you look at before you price out an option or decide on an option strategy.
Great stuff, and thanks for always coming on to Striking Options. We want to thank you for tuning in to Striking Options. And make sure you tune in every week as we will continue to strike options.